Well, thank you very much. I'm going to run through this briefly. Thanks for giving me time to present. I'm going to quickly present on the Centaur Flexible Fund and some of our views on markets and how we positioned. So just running through. Centaur's been running almost 21 years. Our performance since inception, we've done over 19%, and our initial investors are up over 40 times after fees, outperforming our benchmark by almost 8% per annum. So a very consistent long-term track record. Our outperformance process really based on three components. First, we set up an efficient benchmark. So this is the starting point, how we allocate cash across our fund. Then we look for asset allocation alpha. So we look at three key indicators. We look at quantitative indicators. So these are long-term macro indicators. We also look at fundamental value. And then we also we add our judgment into this. So we think on asset allocation alpha, we can add 1 to 2% additional alpha over and above our benchmark. And then thirdly, we look to add stock picking alpha, really employing our process, which we call the Centaur way. And that's really the three components of our outperformance process. This has all been combined into a stock picking engine, which we've developed, and it's virtually been running unchanged for over 15 years. We do improve it, but this is really the core of our investment process. Has it delivered? I would argue yes. So if you look over 10 years, we've done 15% per annum since inception, 16%, materially outperforming our benchmarks and remaining one of the top performing funds in its category over all time periods. So consistent, strong performance and really testament to our process, which we employ and gives us a lot of control over the fund. We have integrated ESG into our investment process. So over the last year, we've made it explicitly into our investment process. This is a more focus area. We are developing the process, so we'll make it richer as we go along. But just bear in mind, it is a key component of our process at this stage. Looking at global indices, it really has been an exceptional period for global stock markets. Nasdaq's over 5 years to the end of June, up 3.5 times. That is really one of the best performances for any large index over that type of period. The S&P up 2.2 times, and the MSCI World Total Return Index up 2 times. So it's exceptional performance, and that's really why international funds performance looks so good. In addition, you've actually had some rand weakness, which may have also assisted offshore funds. Bonds globally, very low levels. So the US bond 10-year, 1.2% at the end of July. European bonds, minus 0.5%. So you're actually paying European governments to take your cash. And I think one concern is inflation. Inflation has picked up dramatically. This is core inflation in the US. So recently about 4.5%. In June, in July, it was a similar level of 4.5%. European inflation is not nearly as strong, currently around 1%. I think this is a concern and some debate, but I think the Fed is saying if you average inflation over a longer period, so if you average it over 3 years, it still is close to their target of a minimum of 2%. So that's the dotted red line. And this high inflation is really transient and will come down in time. So that's their view. We'll see how it progresses. I think the market is not too concerned about inflation if you look at the bond rates at this stage. Inflation-linked bonds. So these are the real rates on offer in US and European bonds. This is an index. You can see both are minus 1%. And this is really resulting in very strong equity returns and a re-rating of equity returns, because the only game in town currently is equities. You're getting negative real yields in bonds, And if you want to make any type of real return, you have to go into equity. So this is creating this kind of bull market in equities. And if you look at the cyclically adjusted P ratio on the S&P, so the cyclically adjusted P ratio looks at earnings over a 10-year period. It's exceptionally high, and the only time it was higher was in March 2000, where it was higher. And the issue here is, unless we have a catalyst, which I would say is higher interest rates, it may stay at elevated levels. So the interest rate environment is particularly important internationally. South Africa, in contrast, is offering very high real yields. So the orange line is the nominal yield curve. You can see on 10 years, we're earning over 9%, 15-year bond yields over 10%. And the real yields, you can see the gray line exceptionally high, 15-year offering 6% real yields. That's compared to 5-year historic inflation, which has been 4.5%. So very high real yields, but I think the risks are very real. So if you look at SA debt to GDP, that's the dark blue line, that's historic. Since 2008, constantly climbing. But what is concerning is, let's say in the 2020 budget, that's the light blue line. They estimated that it would slowly go up debt to GDP to about 70% in 2023. With COVID, you saw that jump. So that was the dark green line in October 2020 at the supplementary budget review. Debt to GDP jumped to over 80%. And then at the most recent budget, our debt to GDP has been revised upwards. And this really is a concern. I think the market is rightly concerned that debt ratios are persistently worsening. Our cost of debt is exceptionally high, our real cost of debt. And if we look at what's required is economic growth really needs to pick up. And I don't think the government has put in initiatives really to accelerate economic growth. So I think there is very real risks on the fiscal side. The Rand, we monitor purchasing power parity. We find this a very good indicator. We find a contrary trading strategy on the Rand is generally best. So when the Rand is exceptionally weak, I bring Rands back and sell when the Rand is relatively strong. We've got a fair value of 13.20. It's currently trading at about 14.85. That's about 14% off fair value. We think the Rand, should be some discount to fair value for political risks. We've seen riots. We do have fiscal risks. The one issue about the Rand is we do see asymmetric risks on the downside. So if we run into fiscal crisis, the Rand could depreciate quite a lot. So you do need a large Rand hedge element. But having said that, our consensus view is it will actually remain resilient over the next 18 months. I think on the economic outlook, I think good policy progress has been made. If we think where we were 3 years ago, these are massive positive changes. So restraint on public sector wages, renewable energy, electricity. So they're resuming new tenders. Corruption, there has been some progress and tentative steps on infrastructure spend. I think there's stimulus in the form of lower ESA interest rates, strong terms of trade. So both iron ore, platinum group metals are booming, and there's really a global boom due to international stimulus. I think there's a lot better confidence amongst CEOs and a positive base effect. So this is leading to a strong equity market and more willingness to invest. I think COVID's going to be with us well into 2022, creating a stop-start economy, and certain industries like hospitality and tourism very badly affected. I think there's really enormous lack of state capacity and excessive red tape as a bottleneck to growth. I think the KwaZulu-Natal riots Negative economic impact, also highlighting the lack of state capacity, but also raising our risk premium. And a more of a medium-term risk, which really concerns me. The economic foundation is very weak. Currently, there's a resource boom due to booming platinum group metal prices. But I think if you look at electric vehicles and the adoption in the late 20s, in the latter half of this decade, we're going to see a massive decline in palladium demand and rhodium demand. And that's going to be very adverse for South Africa. And South Africa really needs to prepare for that eventuality. So I think economic growth, we're going to see, strong growth off a low base, possibly around 4% this year. But thereafter, we're actually looking at just to call along between 1% and 2% for the next 3 years. So you can see what GDP looks like. We based it to 100 at the end of 2009, at 1% growth off the end of 2021. We're looking at GDP actually to be below its peak at the end of 24, whilst at 2% growth, we do surpass our peak, but not a hell of exciting outlook on GDP. I think on the Ps, they don't look very elevated. This was at the end of June. So the PE on resource, close to about 6 times. That's because resource profits are very, very elevated. The financials about 10, and the Indy 25. I think the key problem here is that growth is very, very muted. So in order for the Ps to be much higher, I think we're going to have to see higher growth, which we don't see coming through as yet. So there's a marginal re-rating story happening, but once that comes through, we think returns won't be as strong. I think what's very important is to bear in mind the interest rate environment. We found during low interest rate environments, equities perform exceptionally well, and this guides our asset allocation. So you can see in our loose phase here, equities return 26%. In the tight phase, they return -1%. We're currently in a loose phase. So you can see within the Centaur Flexible Fund, we raised equity content late last year quite dramatically. You can see at the end, we're currently at about 84% equity content. Between 2015 and 2020, we were actually underweight equities structurally. That was during the tight interest rate phase. So we've upped equity content to benefit from lower interest rates. I think although optimally SA bonds look attractive, I think they're very real fiscal risks. So we're neutral on SA bonds. I think it's been an opportune time to invest in SA equities. Maybe it's getting a bit later now. So we first flagged this early in the year, and we are fully weight. And we're looking at more higher quality shares, so not low quality shares, with good cash generative abilities that can grow. We think there's a good prospects for the resource super cycle. So we're looking at elevated resource prices for extended time, really, because there's very little new supply coming on stream. Things like iron ore, which is particularly important. There's very little new major supply coming on globally. So we think iron ore could be at an elevated level due to excess demand. And we actually used weakness in July to upweight resources quite dramatically. We're cautious on global valuations on a macro level, but having said that, on a stock basis level, we do some very high return opportunities. We're looking at the range of 15% plus in hard currencies. For example, we've bought a range of shares, some value-orientated shares like Dell and Hewlett-Packard, Stellantis, which has really performed well, Entain, which is a global gaming giant. We're also improving the quality of the portfolio of our switches. For example, SAPI, we traded out of SAPI into Anglos, showing a lot of profit on that switch, and similarly Netcare to Life Healthcare. So improving the quality of the portfolio of our switches. At the end of July, our equity content was 83%, and fixed income 17%. You can see JSE equity, we're slightly below benchmark. We're actually 6% below benchmark, but world equities, we're 9% over benchmark. The reason why is we're substituting offshore shares for local shares. So, for example, very underweight Naspers, but for example, we overweight things like Entain, which is also a technology company. Just some of the select large equity holdings. I think you're going to see shares that you don't see in a lot of portfolios. Entain been an unbelievable performer. It's one of the top 2 leading online sports betting companies in the world. This industry is growing very, very fast, and its really exciting part is it's going to be a major player in the emerging US sports betting industry. We bought this on a P of sub 10. It's more than tripled, but we still see good legs, and we've actually just retained it, so it's over 6% of the fund. Exor is one we've had for a long time. It's a European holding company. It's trading at a 40% discount to the sum of the parts. What we like here is really John Elkann, the CEO. He's still relatively young. He's about 45, but he's created immense value in this company, and we think this is not fully recognized. Aspen we bought last year. It's doing exceptionally well. It's over 5% of the fund, but we're still seeing returns of 15% plus. African Rainbow Minerals, we topped up, so we topped it up in June. It's got a nice mix of resources, got a lot of cash on the balance sheet. It's empowered, and you know it's moved up, but it's still trading at over 30% sum of the parts. Stellantis, we like management here. They've got a very good electric vehicle strategy, one of the largest car companies in the world. And we're quite excited about their transition to electric vehicles. Also been a very strong performer. Life Healthcare we bought last year opportunistically when it fell out the index, but we think there's good recovery in their hospitals. So I think just summing up, we do have a lot of stock picks which other fund managers don't. We use an independent approach. We look at the quality of the business, quality of management, and competitive advantages. And certain industries, let's say like Stellantis, people say that's a bad industry. We're saying it's got scale to be competitive advantage. We think strict management are employing the right strategy, so we're backing them. But having said that, we did purchase that on a P of 3, so we bought it at an exceptional price. I think just concluding, we're operating very smoothly. The team has been bolstered, just 3 recent new appointments. I think our process gives us an edge to outperform our benchmarks. I think the portfolio is very focused. We invested in excellent equity opportunities, and we still expect very strong real returns. This year has been a very strong year. We're up over 20%. Our team is youthful, but loads of experience, and we've got a proven ability to outperform. So Centaur's really on top of its game. Really and focus on delivering superior performance to our clients, really continuing a track record we're particularly proud of. Performance is in our DNA. It's really what drives us, and we intend continuing to deliver in the future. Thank you very much for your time.